Podcast. I am your host, Josh Appelman, founder and CEO of Appelman Properties. Today, we're joined with Greg Dickerson. Greg is a serial entrepreneur, real estate mogul, and mentor who has launched 12 companies and managed $250 million of real estate. An expert in his field, he is now coaching top entrepreneurs and making waves in the global business arena. Greg, we appreciate you coming on today. If you could, let us know a little bit more about yourself.
Hey, Josh. Yeah, thanks for having me. Yeah, I am just your classic serial entrepreneur. I did not go to college. I went in the Navy right out of high school and, educated myself along the way. In 1997, I started a little remodeling handyman company. I built that into a $30 million building company in 7 years, started 12 other companies along the way, and did about 250 million in, real estate deals using my own money, my own financing, no partners. I've done hundreds of millions beyond that, using partners and, doing some joint ventures. But in the initial stages, it was all me. Just reinvesting, all of the cash flow from all of my businesses into, real estate and other assets, and just kind of grew and scaled from there. So yeah, I'm your classic guy that started with absolutely nothing and, built several, multi-million dollar businesses from scratch. And, I continue to do the same thing today. I'm a co-founder in a tech startup, I'm doing deals all the time. I invest in markets and crypto. So, in the second half of my life and my career, and just, excited to be here.
That's phenomenal. So what led to the massive growth? 7 years, $30 million. What was the catalyst?
Yeah, so I was young. So like I said, I went in the Navy right out of high school, natural born entrepreneur. I started as a kid, just doing odd jobs, doing whatever, so I had an innate desire within me to achieve. And, I moved to the Outer Banks of North Carolina in 1997. I was going to open some restaurants. Instead, I started a little handyman remodeling business because I was trying to get some work done on my house. And there was nobody would return your phone call. And where there's a problem, there's an opportunity. And where there's a big problem, there's big opportunity. So that's kind of how I got started. And then I started as a remodeling contractor. That's all I was doing. I was doing work for people that were coming down, buying, $1 million beach houses and hiring me to do a bunch of renovations on them, like put a pool in, closing the ground floor, create a rec room, movie theater, that kind of stuff, to increase the income. And it was phenomenal how those things were working. So I started learning from the people that I was working for, doing projects for, that were coming down and, buying and renovating houses. And I started building houses, and I learned from the people I was building houses for. And then, I started learning how to invest in real estate and just kind of grew and scaled from there. But, I've always had a fire within me to do more, to, reach my full potential. Like I said, even though I didn't go to college, I was very self-educated. Nobody in my family were entrepreneurs. None of them were business people. None of them were executives. My dad was a 20-year career military, went in, enlisted, came out an officer. So I was raised with that discipline, hard work, work your way up kind of thing. But I always wanted to be, my own boss. I always wanted to be an entrepreneur. I just did not like working for other people. So I did the Navy right out of high school. And then after the Navy, I did restaurants, and I always had a little construction side business. So I'd kind of dabbled, off and on through the years until 1997. So I got out of the Navy in 89. In 97, I started my first full-time company, and I've never looked back. I've just been self-employed and, all kinds of ventures ever since. But really, it was pouring into myself, becoming a leader, delegate, or motivator, finding, great people to do the things that I wanted to do, that had already done what I wanted to do. I brought them on board to build the company with me. And then I coached them to success. So I started building multi-million dollar beach houses. I'd never built a house before. So I went and hired the best people I could find that have been in the area for 20 years building those types of houses. And I brought them on board with me, and we built this great company. And I did the same thing with all of my other businesses, just like I'm doing right now in this tech startup. We've got people from Amazon and Uber and Microsoft and all that, in this company. So in the past, if I had a plumbing company, so I had a plumber that, had been there for 10 years before me, had a company, and I just brought the business and the marketing end of the game. And he was the technical aspect. And, I bought the company, blew him up, and turned it into the largest plumbing company, like literally within months. So really, that's where it is. It's where you have the technical expertise that meets the marketing and the leadership, and you put that together, and that's where you can really explode your results fast.
Yeah, that's huge. You got to have a very competent operator, someone who does have the technical piece of it, who can serve as that arm. But then you bring the business, the financial arm, the marketing piece. And it can be a very beautiful thing once the dots are all connected, for sure. So you've developed apartment complexes as well. Is that correct?
Yeah, all kinds of stuff, all types of commercial, residential. Starting with little spec houses that were 3-bedroom, 2-bath, 1,200 square feet up to multi-million-dollar beach houses, commercial offices, warehouse, industrial, multifamily, retail, pretty much everything, restaurants. I built pretty much everything ground up.
What would be for a listener who's wanting to know how to build their own, say, strip center? What would be the first thing that they would need to do in order to get the process started?
So as a developer, you're going to hire professionals. So you're going to hire, your development team, your consultants, and your general contractors. So you need the right team. You need the right general contractor that, has been in the business, that's what they do. They build strip centers, maybe some other stuff, but you want somebody that's been doing that for years, that's technically competent, that's financially sound, that has a good reputation, that's not going anywhere because they're going to warranty the product. Then you need good architects, engineers, all of your other environmental consultants, everything, around that. But really at the end of the day, the key is location. You got to have the right location, because not every use is right for every location. Not every location is right for every use. So real estate's hyper local. So the first key is understanding highest and best use of a property. So if you want to do a strip center and you have certain tenants that are going to go in there, maybe you got a Starbucks and a Chipotle and a hair cuttery and something like that. Well, you need to be in an area that suits their profile, demographics, maybe a Starbucks, things like that. You need to understand what their requirements are, what their leases look like, what they're going to pay, so that you can reverse engineer the numbers and make sure the economics work. And then you go shopping. Or if you're just going to do something on spec and you're just going to build a center and hope they'll come, then you need to make sure that the building is appropriate from a size standpoint, a location standpoint, that's going to attract some tenants. But it's always better to reverse engineer the process, have your tenants lined up, and then go hunting for the location for them based on their profile, their demographics, and what they can pay, because you can back that all into your land cost and usage and things like that.
Yeah, you can take the lease to the bank and you've got the things pre-funded essentially.
Makes it easier. I mean, you can do it without having things pre-leased, but it makes it a lot easier. And there are certain times in the economy where banks are going to want to see leases in advance, but sometimes the last few years, they didn't really care about that. It's really changed here. Here in the last 6 months, 8 months, since the end of last year, the banking environment's really changed.
Yeah. What is what's one of the best developments, or I guess not the best, but one of the ones that you liked everything about it the best? Can you describe that development?
I've got several, but, I always go back to my first deals, because those are the ones that launched me. And, the first thing I ever did right out of the gate was an oceanfront hotel that I had purchased, and I tore it down. I had 3 oceanfront lots underneath of it. And that's what really launched me as a multi-million-dollar builder. That was my first real development project beyond just doing some spec houses. And that was a lot of fun. And there was a lot of just everything that came together around that. And, I was buying a property to build my dream house on, for my wife and family. And the guy that I bought the lot from had this property under contract, and it was him and 2 other partners. One of the partners was a builder and somebody who was involved in politics there, and, very well known and respected in the area, been there a long time. And they said, yeah, we got cold feet. We don't want to do it. And I was like, I'd never done anything like this before. And it was a $1.2 million purchase. And he said, you want the contract? He said, we're just not going to do it. We got cold feet. And I started thinking, well, what's going on? Why are they backing out? What's the deal? He said, hey, if you want it, just give us our deposit back, take $10,000 to my attorney, and, we'll give you the contract. So I was like, okay, I just jumped right in. I just pushed past, the doubt, the skepticism, wondering what's going on.
Yeah.
Why did they get cold feet? And I said, okay, I'm just going. So I just jumped in, put the deposit up, and got the contract. And then I started working on it. And, I was ultimately built 3 12-bedroom houses on that property. It had 3 lots. And what I ended up doing was I ended up flipping those lots to an investor. So I made, a nice little chunk of change just flipping the lots. I didn't even close on this deal. It was a A to C transaction where C brought the B component. So it was, seller to me to an end buyer. The end buyer brought the funds, went to the seller first, paid everything off, and then I got the difference. So I did one of those deals, double close basically. And then I built the houses for the investor. That was part of the deal. If he wanted those lots, he had to build the houses with me. So I made money on that. And that launched a business model that I, used to propel the company from that point on. And, things just scaled from there. But those first deals are always the really special ones. My very first deal was just a lot flip. It was a friend of mine who was a realtor. He said, hey, he knew that I was successful in, doing some things. He said, hey, we've got this lot over here. You put up all the money, we can buy it. And then my dad's got a client that'll, buy it from us and we can make a profit. And I'm like, can you do that? He's like, yeah. So I said, okay. was like, I don't know, $100,000 I put up. And then, 30 days later, we sold it for 135. We split the profit. And, I thought that was just the greatest thing since sliced bread. It happened in like 30, 45 days. And, so those are the types of things I always look back on that really excite me. And, the early deals that really launched the career.
And then you're like, why can't this happen on every deal? Just a easy, quick flip transaction and cash out, more cash comes back in very quick.
Well, for a while they did, and they do until the business cycle changes, right? Yeah. So, I was around I bought my first house in 1990. That was coming off the savings and loans crisis of the, mid to late 80s. Real estate market was struggling. Developers were going bust. They couldn't give houses away. Interest rates were high. They were at 9%. I bought my first house on a 3-2-1 buy down, which is very popular right now because of where interest rates are that builders are using for incentives. And this was one of the largest builders in the area that I bought that house from, and he was going bankrupt, ultimately did go bankrupt. And that kind of stayed flat for a while till 95 when we sold that house. And, I moved to Asheville, North Carolina for a couple of years, and then ultimately Outer Banks of North Carolina. And when I started there, it was right on the boom, 97. The housing market was just starting to heat up. Real estate was starting to heat up. And, the birth of the subprime lending and exotic loans and all that, through the cycle, we saw the peak in 04, 05. I sold everything, got out, and just started doing investing, and had some other businesses and just doing different things. And, so I went through that whole cycle, and then I got back in right around 06, 07, right before the crash, and was doing some things. And then, in 09, I went through all that. I had about $40 million worth of construction loans outstanding. And, Lehman Brothers was my permanent mortgage lender, and they wouldn't do any permanent financing on the back end because they were failing. So I went through all of that, made it through. I mean, I had a good company, had great cash, things like that. I ended up having to shut my building business down and had to pivot and do other things, But so I've been through a couple of cycles. And, back then, pre-2008-9, it was just everything goes up. Numbers go up. Real estate's, they're not making it anymore. It's not going to go down. And, we've been in that cycle for the last few years here as well, since 2009, really, with all the Fed, easing and low interest rates and things like that. So now we're at a tipping point, where once again, I've sold everything, unloaded everything the last couple of years. And, I'm waiting for the scales to tip to really, get back in hot and heavy. So I've just, lately been playing the markets and, have this tech startup I'm working on and things like that have some good potential. But we're in that stage where, that business cycle is kind of resetting peaks and valleys. And, we're at a very critical point right now. So it's going to be interesting to see how things play out the rest of this year. I'm
glad you brought that up. So I wanted to ask you, as far as your opinion on where we're at in the current cycle, and what a good chip is to play, because there are opportunities that are coming online right now that are from one pocket to another to see what thoughts are on underwriting. And it's almost like you feel like it's a great deal considering where we are coming from. Everyone's buying on pro forma, but are they going to be even better deals here in the next 6 months? So it's kind of foolish to buy now, or is it a strategy to buy now? Things can also change in 6 months. The Fed can. What's your opinion?
So it depends on your business model and your availability of funds and equity and things. So I mean, if you can raise capital steadily, and you don't have to worry about, if I do a transaction today, I can't do one tomorrow. That type of thing. So, if you have a good business and you're consistently raising capital, then if the deals make sense, do the deals. You just got to be careful because rents are contracting in some areas. So you need to make sure that you've got accurate rent growth calculations, that you're, accurately assessing the risk. Interest is your big thing right now. And, deal volume is down like 70-80% across the board right now, transactions in multifamily, because, interest rates, just don't make sense. Deals aren't penciling. But there is an opportunity coming where a lot of syndicators are in trouble. They overestimated. They got short-term bridge debt, floating rate debt, and it's crushing them. And there's a number of syndicators that are well below their DSCR. Basically got cut in half, went from a 1.25 to 0.6, 0.7 that are on the lender's blacklist, right? Or not blacklist, but watch list right now. Yeah. So there are going to be some really good deals they're going to retrade. The question is, even if they retrade at a 30% discount to what they purchased, does that even make sense, with given interest rates and condition of the property? Because when a deal's in trouble like that, a lot of times first thing they stop is spending money. So the property goes into disrepair. So you've got to factor that in. There might be some vacancy. It gets a bad reputation in the market. it creates a good opportunity, but the question is, what's that delta? What kind of discount can you get it? And we've seen a lot of office properties selling for huge discounts, stuff that traded at 3, 4, 500 million selling for, 100. We're seeing multifamily properties that traded at 100 million sell for 70, 60. Question is that still a good deal?
Yeah.
So, there are going to be some big opportunities. There's 1.5 trillion worth of debt that has to be refinanced in the next, year and a half, 18 months. So there's going to be a lot of deals coming, back on the block for sale. There'll be opportunities to take over loans, things like that. So yeah, it really just depends on your business model and the availability of the funding that you have for deals.
Yeah, and stomach for risk. It's things can pivot so quick. Just like I go back to COVID because things essentially just shut down. But then some of the best deals that people bought were through COVID, and then it skyrocketed to even beyond, way beyond of what it could have, what anyone said it could go to.
Oh yeah, rents went through the roof, which was amazing. During that time, and rents have just really gone up. And people have been pushing, but at some point renters will push back. But if you're in the right area with the right properties, you can maintain those rent increases. But as more development comes on, that puts pressure on existing inventory. Developers, their builders and developers are the most efficient in the market. We price accordingly and appropriately, and we can take bigger discounts quicker because we have bigger margins in these properties. So it's just going to be interesting to see how things play out over the next few years. But, in the right markets where everybody moved to, there's still ample demand, where the deals can make a lot of sense.
Yeah, for sure. So you've managed $250 million in real estate. What's the largest deal that you've taken down in your career?
Yeah, so that was, early on, just my own personal funding, that I did, but I've done stuff beyond that, but, probably around 70, 80 million, something like that. And that's what I kind of help, people with now in terms of their deals and their transactions is, going from that, $5 to $10 million level to the, 20 to 50, and then ultimately up to the 100. And really a multifamily, the sweet spot really is, finding, core plus, where you don't have to really do anything but just increase rents. You just find a good property in a good location, class A or B, that you've got, good rent growth, and you don't really have to do anything, well amenitized, good property, newer. I mean, those can be really good plays at the higher level. Where people mess up is they try to do opportunistic or heavy, or value add at the higher levels. And that's where they get in trouble, of the deal spectrum, those $100 million value add deals. That's where you can get a lot of trouble because they just take so long and they're so big, and it can be inefficient. Now, the big value add, opportunistic deals, those come at the, lower level of the spectrum in that 10 to, $50 million range. And there's, obviously real estate's hyper local. So there's, variances in between and things that work in between that. But really what I like right now is land development. Builders are hungry. Builders need land, they need lots. And, pretty much in every market, that's a big issue right now that can be solved. But, land development takes a while. It's a year or two to get a big, substantial, project through the pipeline.
Get the entitlements done, the approvals, and builders don't want to go through the emotions of they want to buy the lot and build. To go through the full entitlement process is a horrible process. Personally going through it.
It is. And you can, that is a business model where you can do the entitlement process, then turn it over to a builder to do the horizontal, largest one I was involved in there was like a 1,400 acre project, mixed use development. And that took 10 years, 10 years to get through the pipeline. And, it still has some stuff that's finishing out, but it does take a while. The entitlements can take a while, but, we can't build through the demand in housing over the next 10 years. I mean, there's a 10-year backlog that it would take to build our way through the inventory problem right now, unless interest rates, continue to climb and stay up there for a while. But the housing market is in such a position right now with people locked into lower rates. There just isn't going to be a huge pipeline of inventory. So we're kind of trying to build, and those units are getting absorbed as fast as the builders can build them. So it's kind of an interesting time. Multifamily is a different animal. There's a lot of multifamily in development coming on the pipeline. That should put some pressure on rents, as we go along. But at the end of the day, as long as the metrics make sense and you've calculated the risk accurately, and you can withstand any kind of a shock if that hit comes through, then you'll be okay. And that's really where people make the biggest mistake is, not accurately calculating those risks.
Yeah, I think builders they're creating another squeeze because essentially they've stopped building market houses here in I'm out of Cincinnati, Northern Kentucky. Instead, they're focusing solely on pre-solds, which of course makes sense with the environment, but at the same time, it squeezes the available inventory.
Yeah.
So it's there's a balance, and we're certainly out of balance. And the 2.7, 2.6% interest rates that are out there, those people don't want to trade. They're not going to sell out and then have to go and get into a 7% mortgage or a 6.5. It's just there's economic drivers that are making it tough to know which direction things are going in.
Yeah, it's a tricky time, from you'd asked earlier about where we are in the economy. We have another interest rate hike, potentially coming in July here. I don't know when this is going to air, but we're talking July 10th right now. So the Fed's going to meet, I believe it's the 25th. We'll probably get a 25 basis point rate hike, puts pressure on commercial rates. That's going to put more pressure on commercial and multifamily. The 10-year has stayed up, which is keeping pressure on the 30-year mortgage, which affects the residential market. But you can still get interest only in buy downs, in the 4.5s to 5s. So that's kind of keeping the train rolling. But the market's cooling off right now. Seasonality, summer slow in the housing market.
Yeah.
The big thing is there's still potential issues with banks rolling forward as interest rates go higher. The economy with disinflation is potentially, could potentially slow down, but the labor market is so strong. We're a consumption-based economy. People are working, people are making money, people are spending money. A lot of money was made over the last few years. So that's kind of keeping, things going. But I think what a lot of people are discounting is the fact that, the rates are going to stay higher longer than what a lot of people think, which could potentially put the economy into a tipping point. So we're going to get a lot of answers. You've got student loans resetting in September. You got people coming off of that, pandemic, revenge vacation, spending and all that, because the world is open now, putting pressure on, Airbnb in the country in the United States, because people can travel abroad now. So, you've got a lot of people spending right now because they can take those trips. Everything's good. They're still employed. The economy's still good. But once people get back and, the bills come due and, the credit cards from the trips and, you got Christmas coming up and you got student loans resetting, that can cool the economy off a little bit. So I think this Q3, Q4, if we have any kind of a slowing, you'll probably see it potentially there. We've got a lot of earnings coming out, so we're going to see what's been going on with, with earnings for companies. So, it's an interesting time, but the economy is much stronger and absorbing these higher rates and this inflation a lot better than what a lot of people thought. A lot of people are projecting we'd be in a deep recession already.
Yeah, and they're saying that the job creation is more due to people taking on second jobs as well to make ends meet, because it's just so damn expensive for everything out there, which might be a contributing factor, but overall there's still a demand to meet, and that's year over year, and that continues to grow. But there's certainly some contraction happening in different sectors. Just and the Fed, I mean, they'll tell you right now they're doing it for things to break. And until it breaks, they feel like they haven't succeeded to drive down this inflation issue. So I don't know, man. We'll keep on forging ahead. It's
it's interesting times. We're going to get a lot of answers here in the next couple of quarters, and hopefully their goal is to have a soft landing. Which means bringing inflation down without crashing something. That's kind of what they're trying to do. Meaning credit markets seize up. Banks collapse at scale. What we saw really wasn't that big of a deal. It wasn't a true bank collapse, and they have, mechanisms in place to, kind of mitigate some of that damage. It wasn't like what we saw in 08, 09 when the banks were exposed to assets that were devaluing. This was just not enough money on reserves. Your screen just changed for some reason. It says connect the device.
Yeah, I don't, let me see what's going on here. Sorry about this.
Yeah, no worries. But anyways, that's kind of, I'll just keep talking through it. That's kind of where, things are right now, is that's what the Fed is looking for. Some people think that it's, some economists are saying, they're on track for it. Some economists are saying we're not. Nobody knows the answer. All we can do is just, this economy has been extremely robust. It's pushed through inflation. It's pushed through higher rates. It's really amazing how far we've come. But there, what it really is liquidity. And liquidity is it's the it's the money was created by central banks over, over the last several years through QE, fiscal spending, created by the government. Everything that was pumped into the economy during the pandemic, all the money that was made in crypto, stock markets, all those types of things. Money that was made in houses that people took equity out. I mean, there's so much liquidity out there that it takes a long time for that to kind of work its way out and drain from the economy. And the Fed hasn't even started seriously rolling off the balance sheet yet. I mean, they've got, I don't know, $1 trillion or more of, mortgage-backed securities that they were buying, even when housing, when rates were 2% and housing was just, unbelievably pressured and, skyrocketing, they were still buying mortgage-backed securities, which makes no sense at all. So, they haven't started to mess with that yet. So there's still a lot out there that needs to be, worked through the system. So it's going to take some time.
Greg, I apologize for my camera here. I am not sure what the connection issue is.
Yeah, that's all right. I think we're good.
Get this.
I'm not sure where you're broadcasting or whatever, but you still got me. You still got that part. So we're
yeah, that's that's it. But Greg, I truly appreciate your time today. So you also do mentoring. Let's touch on that real quick because I think that's important to the listeners. Because a lot of it's connecting the dots. And I'm interested in getting into real estate. I want to know more about it, but how do I connect the dots and getting there? And I think you help connect the dots. Can you tell us?
Yeah. So gregdickerson.com is my website. I've got some courses there. I do one-on-one coaching with people that, different levels. I mean, I've got, medical and dental professionals, professional athletes, builders, contractors, real estate investors, anybody who's, looking to grow and scale, take their business to the next level. Maybe you want to, scale your existing business in residential, commercial. Maybe you want to get into real estate development. Maybe you want to scale into bigger deals, whatever it is. But yeah, I coach and mentor people all around the world doing all kinds of things. I've got people that I work with, just in their business, things like that. So it's a lot of fun. I've coached, hundreds of people over the last, few years, some of the biggest names in the real estate syndication space. I've got some professional athletes that are creating development companies and, things like that are doing big things. And it's a lot of fun. Keeps me intellectually stimulated, engaged, and, involved in a lot of big projects, all over the country.
Well, and with your experience, it helps mitigate risk because if you're out there doing it solo, doing it alone or doing it for others, but you don't have the experience, and you essentially become the biggest liability in a room.
Yeah, exactly. And yeah, I help people make, and that question that you asked earlier, should we be doing deals? I've gone through that with my clients over the last 3 years during the pandemic, when all of this just started earlier this year, with the interest rates hiking, they're like, should we be buying deals with rates, going up and things like that? And, so those are the types of things that, I help people work through and look at their deals and opportunities and things like that. And then I've got a network that all of my one-on-one clients, they connect with each other, do deals with each other, support each other, and a lot of big things happening there. So yeah, it's a lot of fun.
That's phenomenal. That's very cool. Awesome. That's you're a wealth of information, Greg, and encourage anyone to look you up and just if they want, reach out, get to know you more, and definitely look forward to following you. And we'll be talking soon.
Yeah, Josh, thanks for having me.
Yes, sir, Greg. Thanks again.